Hello, ladies and gentlemen. Welcome to another edition of Capital Concepts. I am Jeff Schuler, Director of Research at Spiker Consulting. Now, for this segment of the show, I want to talk about gold. Everybody's been talking about gold lately. We've been primarily talking about palladium and oil, silver, other areas, and what's going on in the economy. But at this point in time, I want to talk about gold. We do a lot of business in gold, everywhere from a few ounces to the metric ton. And everybody's been asking me lately, Jeff, have we missed it? Have we missed it? Have we missed it? Is gold too high? Well, I look at gold now at, 1,055, 1,060. And yes, if you look at history, if you look in the rearview mirror, gold's high. But if you look forward, if you look at its relative value, gold is actually quite cheap. Government statistics on inflation are, to me, bogus. They don't tell the whole story. They don't even tell a fraction of the story. And people try to say that gold is a protection against inflation. Well, it's not. In the last 25, 30 years, gold hasn't even begun to keep pace with inflation. As a matter of fact, in inflation-adjusted dollars, just going back to the early 1980s, gold should be around $2,000, $2,100 an ounce. So what is gold? What makes it tick from an investment standpoint? Gold is comfort. Gold is safety. Gold is hoarded when there are times of economic uncertainty and when there are distinct and evident factors showing that the currency in that given country is going to decline precipitously. That is what we have today. That's what we have here in the United States right now. Gold is not an inflation hedge. If it was an inflation hedge, it would be at $2,100, period. End of discussion. When it comes to protecting us against falling currencies, on a short-term basis, that's what happens. On a long-term basis, not so much, but on a short-term basis, that's what happens. The thing is that ever since 1971, when Richard Nixon, signed the bill that took us off the gold standard, the value of the dollar has dropped in real terms. We know that because if you go back to 1971, and the price tag of anything is much higher today in real terms. Milk is much higher, gas is much higher, a home, even after this dramatic drop, is much higher. Clothes are much higher. Everything's much higher, especially in terms of real dollars. Gold hasn't really kept pace, because since 1971, our government, in connection with our major banks, has been a seller of gold. They ran out of silver, a number of years back. I think it was about 10 or 15 years ago they ran out of silver. Our government has zero silver. But in order to prop up the dollar, they sell gold. So it's an artificial scenario. We don't have or haven't had an even playing field in gold and silver until just about now, because guess what? Our government's pretty much out of gold. Now, there are people that will say, Jeff, that's not true. There are tons of gold, literally metric tons of gold, thousands, hundreds of thousands of metric tons of gold being held at Fort Knox, etc. True. But that gold has been leased out and sold. The people that take the lease in have sold it. And it can't be in two places at once. Physically, it might be residing in our government's till. But in actuality, it's been spoken for. It is a fallacy. Just like our dollar is a fallacy, our gold reserves are a fallacy. We have no silver. We have almost no gold. We might have a little bit, but not much. We're almost done, almost out. So we're getting towards this level playing field. When the IMF says we're going to sell 400 million metric tons of gold, well, where are they getting it from? It's being loaned. It's not really coming to them. It's being loaned and then it's being sold. It's a game, but that game's over. It can't go on anymore. It's been going on for almost 40 years, and the game is up. Because at some point you run out. At some point, it comes time to pay the piper, and that time is now. That's why we're starting to see a breakout. That's why I'm starting to get indications from overseas of millions, metric tons here. Can we get it? Can we get it? Everybody's looking. And I mean everybody, institutions, governments are looking for massive quantities of gold right now. Will it go higher? Absolutely. Where will it go in the short term? I feel 12, 13, 1400 More like 1,400 is doable in the short term. Barclays International has said 1,500. In the long term, I don't even want to say numbers because you're not going to believe them, because they're going to sound silly. Robert Kiyosaki, the Rich Dad, Poor Dad, said almost a year ago in a tape that I absolutely love that if our government were to go to the gold standard, with the amount of paper that's out there, gold would go to $6,000, $7,000 an ounce. Just on that. I'll tell you this. It is my contention that China is getting ready to back the yuan with gold. The amount of gold they're buying off market is staggering. The amount of gold they're buying in market is staggering. Right now in the Middle East, headed up by Dubai, and Dubai is buying gold like there's no tomorrow. And Dubai buys to buy the metric ton lot. They're looking for a currency that is backed by a pool of oil, which makes sense, gold and silver, called the calamity, means of the Gulf. They've been putting that together for a couple of years, and it looks like 2010, it may just come to fruition. And what happens then? We have to go to a gold standard. The upside potential for gold right now is silly. But the need to own gold right now has never been more critical for the American public. Whether it's 5 ounces, 1 ounce, 10 ounces, 20 ounces, whatever you can do, you need to have some gold and put it away. Now, you can buy coins, and your markup will be 15, 20%, sometimes a little higher, sometimes a little lower, but it's about 15%. Make sure you get the real gold. You get the maple leafs, you get the American Eagle, things like that. Make sure it's 0.9995. Fine. Get ingots that are stamped, a little bit cheaper as far as the markup goes, imminently tradable. You'll have a liquidity problem, obviously, if it skyrockets. Who's going to buy it back from you? But you'll use it to buy groceries and things like that. Gold mining stocks, not so much. ETFs, not so much. I told you another thing about oil, what the ETFs were doing, the investigations thereof. But you want a pure play, then you go with bullion. That's what we do at Spiker. The actual bricks held on deposit at a major depository, primarily in London. It's the best way to go. It's the most liquid way to go. You're guaranteed liquidity at any price, and that's really the best thing about it. So if you want to make money right now, it's precious metals. If you want to protect your assets, it's gold. And honestly, if you want to put some money in your pocket at the same time, gold is an absolutely fantastic buy. Well, ladies and gentlemen, I hope you enjoyed this segment of Capital Concepts. I hope it works with you. Get in contact with us. You see right down at the bottom of this thing, spikermetals.com. It'll tell you how to get a hold of us. Have an absolutely fantastic day. Until we next speak, may God bless you all.